Hello, everybody. Welcome to Zero to Launch webinar. So we're going to give everybody a couple minutes to join, and while you join in and settling in, grabbing a cup of coffee, I'll tell you a little bit about who we are and what we're doing here. So my name is Lena Levine. I'm the founder and CEO of the digital product agency called Furcoda. And I started this webinar series with the purpose of supporting entrepreneurs that are launching their first tech company, or maybe already have a product and company that they're running, but looking for the resources to scale their businesses. And what we do, we invite different industry experts to these talks to share knowledge on how startups can build better products on design, strategy, technology side, how they can successfully launch those companies, and then raise the money, connect with the right partners and resources to grow successfully and avoid common mistakes that they typically make. So, and today we have a guest speaker, Denise Edwards. And Denise is the founder and CEO of SaaSLaunch.io, an investment consulting firm that specializes in getting SaaS companies investors ready. After more than a decade of working in tech sales in different countries around the world, including Africa, Ireland, Spain, and working with the top technology giants such as LinkedIn and Oracle, she built new business that helps startups to increase revenue um, quarter over quarter for their books of business. And Denise have developed relationships within the industry and with investors in the industry. And now she's leveraging her business development skills and connections to help founders to get investment opportunities. So, and today, Denise will be sharing her knowledge on fundraising, and especially the topic of why early stage startups need fundraise partner to successfully raise money for their companies and the product. So with that said, Denise, please take the stage.
Thank you so much, Lena. Appreciate the time and appreciate everybody's time. Let me share my screen, and then let's dig into the presentation and the webinar here.
And just one more thing, as Denise is going over her presentation, we do have a Q&A tab in the chat. So if you have any questions, please post them there. And at the end of the presentation, we will answer those.
Yes, for sure. Can everybody see my screen, the presentation? Lena, can you see that?
Yeah.
Okay, perfect. So hi everyone, and thank you, Lena, so much for the introduction. So as Lena mentioned, my name is Denise Edwards, founder and CEO of SaaSLaunch. And today I'd like to share some of the learnings that we've seen over the years, and specifically focusing on why founders should have a fundraise partner, which is actually a must-have, and for an early stage startup looking for investment. So what I'd like to give you today as an overview is we're going to take the next 20 to 30 minutes to really look into a few things. So we're going to look into like market stats, some of the things that are happening within the market. And then next to that, we're going to look at, the investment stages and investor types. So what we've seen is that many founders, once they go for funding, depending on which stage they're at, they are looking for funding from investors that are not going to be in that stage of their process. So we'd like to kind of, make clear in which stage, which investor you should approach with. And then also looking at approaches, the common approaches to fundraising, what are founders currently doing to fundraise? And then also looking at, the pitfalls that we are guarding basically our founders that we work with against. We're going to look at what's the best new way forward. And then we're also going to provide you some key takeaways to, simmer on for the next coming period. So as Lena mentioned, I'm the founder and CEO of SaaSLaunch. So we specialize basically in helping early stage tech startups get investment. So how do we do this? We help them by connecting the founders with investors within our network, and then also helping get deals across the lines and checks signed. That's basically the pillar of where we're focused on. Our stages range from pre-seed to seed to Series A, so really the early stage of a startup. And we actually started in 2018 because we started as a sales and marketing service, and a few of our clients asked us like, hey, could you help us with the fundraising? And so we did. I used obviously my background working in sales and working in tech sales for the last 10 plus years to basically do that. So I have experience of working with companies such as Oracle, LinkedIn. I've worked for Agilent Technology staff base, so the big conglomerates, but also the smaller startups. And through working for those startups, I got into contact with investors, and that's how we're building, our investor network and connecting them to the clients that we're working with. So let's get into it. Just a select few of the clients that we've worked with, for you to get a little bit of an idea. Our clients range from the regions of North America, Latin America, Europe, Africa. So those are like the regions that our clients are in. And one of the success stories is Sign a Deal. We help them get around 50 VC meetings in under 40 days, and they could sign a check for a multi-7-figure deal. And then also Life Wizards Academy, Life Wizards app, they got investments into the company, and that investor is actually also now opening up more sales avenues for them. So just a select few of the clients that we're working with. So now let's go into like the meat of why we're here for. So let's look at the reasons why startups usually fail. And let's go and look at from number 3 up until number 1. So number 3 is getting outcompeted. So there's a plethora of reasons why, your competition might, be a little bit in front of the game, let's call it like that. It could be that they have more financial means. It could be that, they have a better unique selling proposition. It could be a plethora of reasons, but that's just the number 3 is that, your competition is basically getting out there and beating you to the punch, if to say so. The number 2 reason is no market need. Now, in this case, we look at product market fit. We look at the sense of many founders come to us when it's about, or many founders are telling us that they develop a new solution, they like the solution, but they don't know how to basically, go to market with that. And this is obviously where Lena comes in with building an MVP and stuff like that. And when it comes to most founders, because they have a technical background, they usually develop a solution which they think is going to work in the market. But when they've developed the solution, they've invested a lot of money in the solution, which is the perfect solution. Then they go to market, but then they hear crickets because they're not seeing that people are, really buying their solution. And that's where there's a product market fit that's not there. So that's one of the second reason why startups could fail. And then the number 1 reason is basically running out of cash or failing to raise new capital, which obviously is of importance. Do you want to move your startup forward? So let's look at a few stats in the market, right? So if we look at, for example, 58% of startups have less than 25K at their disposal during the startup phase. Now, from our experience, knowing even building an MVP is going to take you much more than this 25K. So let alone if you only have 25K to your disposal, what it would mean for the continuation of your startup. And only 40% of startups are able to become profitable, meaning that 60% of the startups are not profitable. That's more than half. And if we look at startups that are, getting venture capital investments, it's only 0.05%. Now in the next slide, we're gonna look at when is a VC fundraise or funding of importance and in which stage. But again, 0.05% is a very, very small amount. And then looking at 1 in 4 businesses don't receive the funding that they require for growth is obviously a challenge. And if we look at the percentage of startups that evolve into a unicorn, it's only 1%. So let's say the Ubers of this world, or the Airbnbs of this world, the Slacks of this world. And the unicorn is basically a company that's valued at 1 billion or more. And why is this of importance? When it comes to venture capital, which is one of the funding sources, right? VCs like to look for companies that could be a unicorn because their return on investment is going to be so much more than if it would not be a unicorn. So that's the reason why the word unicorn is used so frequently in the VC world. So if we look at a few challenges in the market, so if we look at even before COVID, investors were basically writing checks left and right and investing in companies a little bit more freely. And then COVID hit, and now we're looking at the barrel of a recession or in a recession, depending on who you're asking. And obviously also things happening in the market, FTX, for example, crypto, all these things that are happening that are making investors more wary and more careful in how and where they're going to invest their investments or their money in. So more selective than ever before. And as well, dry powder. What does dry powder mean? It basically means what's the amount of money that an investor still has, or a VC firm still has to invest in. VCs usually have a 10-year period in which the first 5 years they invest in a few companies, and then the next 5 years they basically want to get more, or they want to get their ROI back, 10x, etc. So the dry powder is basically what do they have left to invest into companies, and that access to understanding if a investment firm or an investor has that dry powder. That's also a challenge because as a founder, you would want to know if your investor still has some money left to invest in potentially your startup, right? There's high competition of tech startups. There's above 1 million startups worldwide that actually started in 2021, according to Statista, which if you would look at it from over 365 days a year, that every day 3,700 startups start or launch, which means, again, competition is high, investors are more selective, there's less access to dry powder. How do you know where to focus on for you to get that investment? And again, it's also more competition, right? So more startups starting, the competition for each investment dollar from the investors that are not really, let's say, open to investing so frequently is obviously also more challenging. And on average, it takes around 100 opportunities to get just a few term sheets. And term sheet meaning at the end of the full due diligence process with investors, what is the term sheet saying, basically saying like, hey, we want to invest in you and these are the terms that we're going to invest. So around 100 opportunities, if you have around 40, let's say, shortlisted investors, then you will have a few term sheets at the end. Okay, let's look at the funding sources. So according to the Silicon Valley Bank, the biggest source of funding is VCs. Now, again, we're going to look in a little bit on what that means, but around 58% of funding comes from VCs. And then around 19% comes from angels or micro VCs, which are smaller firms than VCs. And then if we look at private equity and corporate investors, that's basically more of the later stage types of companies. But these are also forms of funding. And then obviously you have organic growth. Some companies bootstrap their way, so they invest their own, let's say, money into the company, or they grow it from the profits of their revenues, basically. So now let's go to the different stages of fundraising. And this is of importance because many founders come to us when they're, for example, in a pre-seed stage, and then they want to connect with VCs, and they're connecting with VCs, talking with VCs, and all the VCs say no. It's basically because you're also in a different, let's say, range where you should be. So we're going to focus on the pre-seed, seed, and Series A. So that's our forte. And basically when we go to, let's look at the pre-seed stage, right? That's the funding stage. That's where the idea and development is. This is where, for example, Lena helps founders with the ideation stage, with the development of an MVP, for example. And when we look at, let's say, the source of where you can get, let's say, your funding from, you can look at family and friends, for example. Angels is another network where you can get your funding from for pre-seed. You can bootstrap your way up. Incubators is also a way where you can, go into an incubator. They're going to help you with the MVP and then also provide you potential of funding. And you can also do crowdfunding platforms, and things like that. Now, the amount, this is something that is this differs per, let's say, country and per region. So this is just an example from what we're seeing with the startups that we're working for. So the amount basically means what would the approximation of an amount be for a pre-seed stage. If you, for example, compare this here in Europe with the US would probably be a little bit more than 100K. But just for easy reasons, we've shown this. So the amount would be around 100K. Metrics that investors want to look at is, for example, are you committed as a founder, right? Because you have an idea, how is the founder or how is the investor going to know that you're going to really go through with your startup, right? So the commitment, what's your background? Have you done this before? Those are metrics that at a pre-seed stage that investors look at. And when it comes to dilution, basically it means how much equity are you providing to these investors at this stage. Usually 10 to 15%. Again, this ranges per region, per country. Okay, if we go into the seed stage, which is more of the product market fit, you have an MVP and now you're going to go to market to get new clients. So the sources of income which you can go for, or the sources of funding that you can ask are, for example, micro VCs. You can ask funding from them. You can go to family offices, also angels and angel networks. The amount is usually ranging between 100K and 2 million, again, depending on your country, but this is an approximation. What are the metrics that investors look at when it comes to seed? Well, they look at potential churn, usage, the usage of people coming on board, because this is the phase where you're going to attract more clients or wants to have clients on the solution, using your solution. And the financing is for survival, right? To go from point A to point B, maybe next 12 to 18 months runway to really build further on your solution. Dilution, again, 15 to 20%. This is just a range. It could differ per country. And then if we go to Series A, that's basically business model fit. So you've come from product market fit. You are seeing that people are liking the solution, that they're buying the solution or using the solution. And now you want to grow that further. So where can you find, funding? VCs, that's basically where you can go to, because this is the right stage where VCs are interested, because you have some traction. You can go to accelerators, for example, as well. The amounts range between 2 to 10 million, again, depending on the country and region. And the metrics that investors look at is churn, customer acquisition costs, lifetime value, for example, conversions. And this financing is for growth, right? So maybe around 20 to 30% equity or dilution or equity that you're giving to the investor. And just on dilution, it's very important to know that the best practice for founders is to have 50 to 60% of the equity in the company by the time they finish a Series A. We've had many founders that have given a lot of equity at the beginning, and they actually, I wouldn't say it got diluted, but the thing is, if you give too much equity at the beginning, then the next few rounds are going to be harder for you to get investment, because the cap table is a little bit skewed, if that makes any sense. So going into just a simplified version and process of fundraising, and this is basically more for VCs, but you can also apply this for family offices and potential angels, but angels are going to be a little bit more simplified, but this is basically how it works. So once you get a meeting with an investor, an investment firm, the first meeting is going to be just a pitch kind of session. You're going to introduce yourself, what the solution does, etc. And then they're going to see if there's going to be a match. if there is a match, then the next step is going into the basic analysis. So looking at, what are your revenue plans, your competitor reviews, or reviewing the competitors in the space, having a 3 to 5 year plan, and things like and elements like that. So if you pass that basic analysis, then you go into the due diligence. If you don't pass this basic analysis, then it's a pass for them. But let's say that you pass that part, then it goes into the due diligence, meaning, okay, they're going to have reference calls, potentially with customers, understanding more of, the product and the roadmap of the product, and also going more into the deep dive with regards to competitors. Now, here it could also be a pass, but let's say that you go through this with flying colors, and then the next meeting is actually a partner meeting. So in the first meeting, usually you would be in contact with maybe an analyst or maybe a principal. And in the partner meeting, you're going to have a meeting with the partners. Now, usually what we also see is that before the partner meeting, they're going to have a meeting internally. So the full team, a meeting internally. And then if that's a go, then the partners are going to be in the meeting with you as a founder. And then obviously asking you questions around, the next steps and things like that. And if that all goes well, then you're going to have, as the last step, a term sheet where it's going to be about, what are the terms that you want to negotiate, the legal diligence and things like that. Sometimes the negotiation terms that what we've seen with VC firms is that actually at the beginning, after the first meeting, and if the VC firm is interested, that they're already preparing like what type of terms that they want to negotiate for, so that at the end it's more of an effective process. So this is again a simplified process of how that basically works. So if we look at founders and how do they usually fundraise, these are a few common approaches that we'd like to share as well. And what we've seen is that many founders have tried to connect with investors at events. Now, as a founder, you're or a CEO or a CTO, or that's what we've seen. And you have your daily tasks that you need to do. So if you need to go to an event, it's obviously going to be taken off of the core job that you need to do. Connecting with investors at an event is a perfect way, but is it scalable? Also getting introductions through maybe other investors or through the network of, let's say, founders itself to get to investors is a great way to get in touch with investors. But again, is it a scalable way? Because if we look at the previous slide, which was, or a few slides ago, which talked about we need around 100 opportunities to really get a certain amount of term sheets. If that is the way that you want to go, then you need to have a scalable way in acquiring more, let's say, contacts with investors and more meetings. They have tried cold outreach, meaning maybe a cold email or cold LinkedIn message to investors. But again, how are you going to scale that process to make sure that you have a systemized way and a consistent flow of meetings coming in? And also, even if you're on the meetings as a founder or as a founder, how are you going to sell your story and how are you going to pitch? So those are more of the common approaches. And then when we look at how, when you approach investors as a founder, what do you need to take into account? So you need to take into account and understand the investment criteria of these investors. So certain firms or certain investors only invest in, for example, a certain region or maybe a certain industry. We have, for example, in our network, a VC firm that only focuses on AI, for example, or a VC firm that focuses on SaaS, but it needs to be a particular type of SaaS solution. So there's also certain investors that only invest maybe in the US, maybe they don't invest in Europe, or maybe they only invest in Asia. So also the region geography is very important to understand. Because if you're a founder and you have a startup that's maybe an AI platform and you're going to go to an investor that only invests in marketplaces, then that's obviously not going to be a fit, and that's going to be also a waste of your time, right? So you need to also understand, okay, what is the investment criteria that they're looking for, and does that coincide with what you do. And the wheelhouse basically meaning, do they have experience with your solution? Do they have maybe other companies that they've potentially invested in or not? And are they interested in your solution? As I mentioned, also understand their dry powder, meaning do they still have a certain amount of financial capital to invest in their company, in your company? Again, in this case, VC firms have 10 years of having a fund. So first 5 years investing in the startups that they find interesting, and then the next 5 years to really get their money going and get their money back, or at least the 10x. So understanding where's the dry powder, and does it make sense for me to go to an investor where I know that they still have some money left, or that they don't have money left for potentially to invest in my company, right? And investors look at the market size. Is the market size big enough for them to get a 10x return? They look at the team, like what have you done before? Have you been a two-time, one-time founder, or a two-time founder? Do you have the team that can really build this solution and grow the solution? What's the product? Is it a product that is interesting? And is there a need in the market? And traction meaning, are customers really buying your solution? Do you have the sales figures to show that you're moving forward with your company? So also a few pitfalls that we want to guard our founders of, and this is what we want to share as well with you all, is there's a few pitfalls that you need to take into account, okay? Sometimes, and I believe I mentioned this in this presentation, giving too much equity away in the beginning can definitely hurt you as a founder. So the thing is, if you give too much equity away at the start, it means that every time that you raise a round, that you have less equity available for other investors to invest in. And obviously for investors, it needs to be added value, right? So they want to have a balance of the amount of shares that they have with or the percentage of equity that they have with the amount of investment that they're going to give you. So be conscious of how much equity are you going to give away, and think of it as a long-term plan. Because if you're going to go from pre-seed to seed to Series A and potentially further Series B, C, you need to really take into account how much equity are you going to give away at each round. Not having a strategy in place to contact investors. Again, founders have a lot on their plate. Fundraising is actually a full-time job. And if you do that next to your core, the core things that you need to do each day, it's going to be very, very difficult if you don't have a strategy in place, because you're doing two things at the same time, fundraising and obviously your core things, and not having a strategy on top of that is going to create a lot of unnecessary stress. So do have a strategy in place. Raising too much too soon. If you raise too much too soon, it has to do with your valuation. So if you raise a lot, it might potentially be that also that your valuation is high. But if you're not showing the numbers, meaning you don't have the traction, you don't have the sales numbers to show that you've raised this amount and the valuation is as it should be, or at a higher level than expected, then the next round is going to be a down round. And when it's a down round, a lot of investors see that as, okay, well, you're not hitting your sales numbers, and we're actually a little bit challenged. It's going to be a little bit challenging for them to invest again, or a certain amount of money that you'd like, because it's seen as a little bit of a downgrade to what you've raised before, if that makes sense. So also starting too late with fundraising. Now, sometimes we have calls with founders that mention that within, let's say, the next 1 to 2 months, they want to close a round and they have not done anything yet. In that case, that's going to be quite challenging if you don't have the network. So we always recommend, have at least 6 to 9 months of runway, so that when you start fundraising, that's still in process and you still have, runway to survive, if that makes any sense. Another pitfall is that once you have a meeting with investors, not following up, that has happened. We've seen that. And it could be a plethora of reasons. It could be that, the founder has a lot of stuff on their plate. It could be that, they forgot any type of reason, but it's very important to still follow up with the investors. Following up meaning if you have a first meeting, try to, pinpoint or put down a second meeting potentially, or if it's not going to be an investor that invests now, do put them on an update, let's say, list where you can update these investors each and every month on the newsletter, for example, and basically talking about, hey, this is what we're doing now, this is the next steps, and really putting them in the know, basically. And the last thing that we're also seeing is not practicing the pitch and not having the answers that investors are looking for. So really, practicing your pitch, practicing how you're going to sell that to the investor, and make sure that you know your company, know what's happening in your company, and have those questions for investors. So what's the new way forward? Well, basically meaning, have a fundraise partner that can really help you with the process. Because again, fundraising is a full-time job, or it could be seen as a full-time job. And a lot of founders underestimate what it takes basically to get that round, to get that funding round, to close that deal, as we say. So understanding that a fundraise partner is going to understand the process, is going to understand the next steps that you need to take. It's going to understand and coach you as well, and consult you in the full process. A fundraise partner can help you with the pitching and selling of your solution. Understanding the way of selling it is also how you can get funding, right? It's just one part of the bigger chain. It's all small things that need to fit well, like a jigsaw puzzle, for you to get to that funding, right? So a fundraise partner can help you with the pitching and selling of the solution. Now, content, material, and strategy is like, for example, what I mentioned, a newsletter for investors that want to be updated on what you're doing. So building content around that, building a pitch deck, maybe a one-page overview, and building around the strategy as well. That's what a fundraise partner can really, really help you with. And of course, one of the most important things is, an introduction to the network of investors. So, a fundraise partner has a network of maybe VCs, angels, family offices, where they can provide warm introductions for you. And that's going to obviously help you to raise quicker, or in a faster pace. And obviously, they're also going to help you. Our fundraise partner is also going to help you in sorting and filtering out the investors on the criteria, right? So as mentioned before, looking at which investors in which regions would have the same criteria as like what your startup, if there's a match between what your startup does and the criteria that they have, basically. We just actually, a few days ago, I spoke with a founder, and he mentioned that he was trying to sort out around 80 investors, so on a list with some details, and it took him about 2 weeks. So that's something that, it takes a lot of time to also sort out these aspects, and that's what a fundraise partner can also help you with. And obviously, everything together, the fundraise partner can help you close around in a shorter space of time than if you would do it alone. Again, because there's many moving parts within the full sequence of fundraising. And if you have those parts correctly, it will help you raise at a quicker pace. Let's call it like that. So a few key takeaways that I'd like to share with you that you can simmer on is, only raise if needed. Don't raise if you think, oh, it's potentially that you need it. No, raise if you really need it. Because if you can bootstrap your way, through the process, then do that. It's gonna, provide you obviously a bit more value in that case. Have runway left. So once you start fundraising, do have at least 6 to 9 to 12 months runway at least before you start the process process of fundraising, and have realistic expectations on valuation and amount. We have many founders that, they don't have a lot of traction. Let's say they're maybe at 30K ARR, annual recurring revenue, and they want to raise 10 million. Again, those valuations could skew, because it doesn't mean the valuation needs to be according to where you are with, your traction. So do have realistic expectations on what amount you want to raise, and obviously the valuation of your company at that moment in time. Properly calibrate your cap tables, so don't dilute yourself too much in the beginning, but do keep in your mind, as in you move forward within every phase of fundraising, how much would you provide equity to your investors for you not to be too much diluted, and for the investors in the next round to be compensated fairly, right? And seek, where needed, guidance from an expert. So again, fundraising, there's many moving parts, and you need to understand each moving part for it to be obviously a perfect line, and for you to get to that funding at a quicker pace than usual, because sometimes fundraising some companies fundraise for 12 months, and that's not where you want to be. So seek, where needed, guidance from an expert. And I am open to any questions. Even after the webinar, you can find my contact details. If you scan this QR code, you'll find the details. Even on the social medias, I have some good content on YouTube if you want to look at that. And you can obviously also email me at denise@saaslaunch.io. So I'm open to any questions.
Wonderful. Thank you, Denise. We do have one question submitted, and if anyone has more questions, please post them in the QA chat. So question from Melanie. What if my team is still just me, one person? So yeah, how should Melanie navigate this situation if she's looking to fundraise?
Then maybe Melanie can answer this question. So is the question that if you're a solo founder, is it more challenging to fundraise as a solo founder? Or is the question, how do you go about it as a solo founder, even if you don't have a co-founder? If that makes sense.
So meaning, how do I convince investors that my team is amazing? Okay, Melanie.
How do you convince investors that your team is amazing? I think if you basically, again, selling the story, right? Selling the story of what your team has done before, or what type of people you have in your team. So let's say, for example, we had one founder, he's a solo founder, and he has a team with people in there that have done amazing things before. They've worked for these big companies, and that's something that you can use in your sales pitch, if that makes any sense. So try to find those small levers that people are going to be like, oh, interesting. So your team has worked with this and this person before, or your team has worked with this and this company before. Those types of, I wouldn't say small things, those types of aspects are really going to work well when it comes to, selling your team, selling yourself, and selling the company.
And Melanie has a follow-up question. Do you mean a volunteer board, something like that? Can it be one of the?
Can be, but it depends also who you have, let's say, in your team. So if your team members have, for example, worked at, I'm just giving an example, at Facebook, right? And they're now helping you with certain type of development work, then that's something that you can basically show as like, hey, we have team members that have worked for Facebook, or we have team members that have worked for or Meta, sorry, it's not even Facebook, Meta. So those types of things you can really pop up for investors to be potentially interested in what you have to offer and your team.
And if it's just one, if it's a solo founder, what you're saying, and correct me if I'm wrong, you're saying that you recommend to have add more people on the pitch deck to show that you have a team, because otherwise that
It
will
depends.
work against
It depends.
or-
So just just to understand. So mostly investors do want to have two co-founders or more, because if they invest their money in one person and something happens to that person, then your money is gone potentially. So yes, they want to have a co-founder just to give a basic understanding. But if you don't have a co-founder and you need to find one, that's also something that that you can do. If you're a solo founder, if you have a team, let's say you're a solo founder, but you have a team that helps you, then that's a little bit of a different situation, right? But if you have a co-founder, you have a CEO and a CTO together, that's basically the best fit. If the question is if your team, if you have a team and you don't know how to basically show it as a solo founder, then try to show what each team member brings to the table, and maybe their background or what they've done, and show that as well in your presentation or in your pitch deck, or however you want to present that. So that's what I would say.
Awesome. Yeah, Melanie says, got it. That's so helpful. Thank you. You're welcome, Melanie. Great. Another question from, let's see, from Andre. What is your pricing structure?
For what exactly? For the pricing of our services?
For I guess, like, yeah, for the services, I guess, is it like a flat fee? Is it a percentage? What founders can expect from working with a fundraise partner?
Yeah, so I think the partners that we work with in the space, everybody has a little bit of a different structure. So you can think of, sometimes they have a retainer fee. So you have a retainer fee and a success fee. A retainer fee it could range between 2K and 6K, 2K and 10K, depending on, again, what type of firm you are. And then a percentage of success fee. Now, a percentage success fee can range between, I would say, 5 to 10% in the market. That's kind of the sweet spot. The average is 5%. And it can go up to 10% if you go with companies that have more than 10%. Then that's on you, but it's usually between 5 to 10%, and then a retainer fee depending on what types of services they do. Do they go into their investor network? Do they do outreach? What is it that they do? But that's basically kind of like how you should see it: retainer and then a percentage.
Awesome, thank you. Okay, and we have 3 questions from Alberto. Thank you, Ms. Denise Edwards, for such an informative presentation, and Ms. Lena Levine for organizing. By way of an introduction, my company seeks to provide a solution within the medical industry. I am presently in the seed stage. So the question number 1, during the seed phase, what are pitfalls when raising funds from family and friends, and how to avoid them?
Good question, Alberto. One of the pitfalls that we've seen is that when it comes to family and friends, you need to have very clear on paper what the expectations are from both sides. So one thing is, you can obviously talk about like the percentage that you're going to provide to your family, but because family and friends are so close, it could be an emotional relationship, in the sense of you have to deal with money and your family members, right? So have everything on paper very clear, like what the expectations are from your side and what the expectations are that they can expect from what you're going to do with the funds, how you're going to use the funds, and what they can expect for the next stages. So have that very clear, really talk about it and put it on paper, because we've seen that sometimes things are not being put on paper, money's just being given, and then sometimes it could be a little bit challenging afterwards, discussing if they want to potentially invest more or whatsoever. So
thank you. So the second question, how do you prepare for the basic analysis and revenue plans? Do you have an example of this analysis? What are example of questions they ask?
Yeah, so basic analysis, financial, right? So we work with consultants that do the financial part for us, for our startups. So what I would recommend is, first off, you have certain tools where you can do some valuations and And if he means cap tables, there's a lot of softwares that can help you that. You can even do it in an Excel sheet. After the webinar, I can give some examples or send some examples. Yeah, I would say look at a few of those tools, which I can recommend. And yeah, I think what I would, yeah, that's what I would say. Have a look at the tools, and then you can obviously look at. There's a few YouTube videos as well that will show you, okay, this is how you can, do cap tables and things like that. So that's what I would recommend as well. And of course, if you work with a partner, that partner is also going to help you with that. So if that is, something that you want to look at, then definitely have a fundraise partner that can help you with that as well, next to those tools.
Thank you. And the third question, what terms of agreements are essential to protect the business from shark investors who want to expedite profits at the expense of the vision of the business, sacrifice the development of business, and may seek a coup to take over the company?
Yeah, that's a difficult question to answer because there's a lot of terms that could be in a negotiation. And obviously, this is something that's legal advice. So I would always say, like, have a legal person. If it's not with the franchise with the fundraise partner, have a legal person look at the terms because, yeah, I would not know which terms exactly let me say it like this. You can have different terms, but you need to have a legal person look at it before you say yes or no. I am not in a position to give any legal advice, which I'm not going to do. So that's what I would recommend.
Thank you. Thank you. And there is a follow-up question from Andre. He asked to clarify what success fee and retainer fee means. It was a question about the fee structure. Yeah.
Yes. So Andre, so a retainer is basically a monthly fee. It's a fixed monthly fee. So some fundraise partners have a fixed fee every month that you pay for the services provided. So again, this could range from 2K up until 10K. And then the success fee basically means once you've raised the funds with the partner together, they expect a certain percentage of the funds that you've raised to be compensated to the fundraise partners. So let's say you've raised 1 million, for example, and the success fee of the partner is 5%. So basically, after the raise, that 5% of that 1 million, that is the compensation that you as a founder would provide to the fundraise partner as well as compensation.
Thank you.
If that makes sense.
Okay, beautiful, beautiful. Thank you. So I don't see any more questions in the chat, so I guess we are good here. So yeah, no more questions. Well, Denise, thank you so much for being here and for sharing your knowledge. If anyone has any questions for Denise, please reach out to her directly. We'll be sending this recording after we finish webinars. And yeah, if you have any questions, please reach out to me or Denise, and we're happy to help you. So thank you, everybody, for being here. Thank you, Denise.
Thank you so much, Lena. Thank you, everybody, for attending.
Have a great week. Bye-bye.
You too. Bye-bye.